Hey guys, and welcome back to the Young Investors Podcast. We're episode 20. How's it going, Brandon?
Yeah, I'm going well.
20.
Yeah,
it's 20.
Pretty good. We've been doing it for a little while now. Getting up there.
Yeah.
I'll be excited when we start hitting like 90s. That'll be awesome. When we like come up to our 100th episode.
50 and 100, those will be really big ones.
Yeah, we'll have to do something cool for 50 and 100. Anyway, how are you going?
Yeah, I'm good. We're a little bit early this week.
Yeah.
We're on a Thursday.
Yep.
At the moment.
Our classic backup day to record the podcast.
Yes.
Give ourselves the long weekend to actually have as a long weekend.
Yeah. If you're not from Australia, on the weekend is Australia Day.
Yay.
Over here, so that's what we'll be doing.
Yep.
Having our celebrations.
Having a barbie.
Yep.
Chucking on our thongs and going to the pool or the beach and eating some snags and all that good stuff.
Absolutely. all the American listeners just clicked off.
Yeah, pretty much. Oh, g'day everyone. Welcome to the Young Investors Podcast. That's how we should totally start it. G'day guys, what's going on? Nah, alright. Classic podcast structure. If you're new around here, we always go through the indices first. We're still going to do that even though we've only got three days worth of indices to go through. And then we've got, of course, the news. And do you want to talk about what we're doing in the middle section of the podcast?
Yeah, so in the middle section, so early on in the podcast, we said we were going to do this quite regularly, and we kind of stopped doing that. But we're bringing it back, and we're going to do an individual stock analysis. So we're going to review a stock, and we will reveal what... Oh, well, I guess you know because it's in the title.
Yeah.
But we're analysing Texas Roadhouse. So it's a restaurant chain, and it'll be interesting to discuss that. It's one that I've been looking into for the past couple of weeks.
Yeah.
Extensively, actually, yeah.
Yeah.
Did you want to... Yeah, go on.
Yeah, I was going to say, I found this really interesting. The story behind this, we're like still researching this one, so we're not like, I don't know, concrete, set in stone that we, love or hate this stock. We're still researching it, but I was so surprised. I remember when you reached out to me and you're like, hey, look at Texas Roadhouse if you've got a chance. And then just looking at some of the numbers, which we'll get to, yeah, this is a really interesting one to go through. So I'm actually really looking forward to talking about it with you today. And then, of course, to finish off the podcast, we always go through Q&A as well. So we've got one Q&A question that we missed last week. So we're going to do a bit of a deeper dive into that Q&A question to round out the podcast. So with that said, should we get into it?
Yeah, I'll just start off with the indices. So this is just since our last podcast, so it's the last 4 days, I guess, is that right?
Oh yeah, 4 days, yeah.
Yep, so we've got the Dow, that's down 0.2%, NASDAQ down 1.2%, the S&P 500 down 0.8%, the All Ordinaries in Australia is down 0.6%, and the ASX 200, of course, is always down 0.6%.
It's always the All Ordinaries and the ASX 200, they're just like always the same. They pretty much never differ. Well, they're so close to each other. It's like ASX, it's the ASX 500, isn't it, for the All Ords, and then the ASX 200. So it's just like, what are those tiny 300 companies? Are they going to make that much difference? But
yeah. And in Australia, our biggest companies are very big compared to the others. I think in the US, there's more of a wide spectrum of sizes of companies, whereas we have a lot of the index is concentrated right at the top of the top 10 or top 20 companies.
Yeah, pretty much. Yeah, that's pretty much the way our system works. But interesting. Nothing too much happening really in the indices so far this week. Keep an eye out if anything does happen for the rest of the week. But so far it looks like it's just going to be pretty standard. Nothing to report really. So let's jump on into the news. And the first news story. Oh, guess what? Guess what I'm talking about today, Hamish?
Would it be Tesla?
Oh gosh, how did you know that? So news today, not today, but in news this week, Tesla is laying off 7% of its workforce, which is a decent chunk of employees, and that caused their stock to drop from $347 to $287. I was going to figure that out as a percentage, and then I got distracted. I'm going to do it right now. So
it would be about 12%, I think.
Yeah, something 13%. Like that. Yeah, I'll trust you on that. But yeah, it's interesting looking at what's actually like who's been laid off. So there's nothing official, but there's lots of reports, and apparently reports from employees in the company are saying that the big hit was taken around Tesla's delivery, sales, and Model S and Model X production teams. So I find this interesting. Tesla, especially now, they're making some pretty decent changes to their business. I think they're focusing much more resources now on the Model 3. I think that obviously the sales numbers that they've been able, or the reservation numbers they've gotten from Model 3 have pretty much pointed them in the direction that they need to change their company to try and get as many Model 3s built as possible, because that's where the demand really is. So I feel like that's causing them to kind of pull back on their other vehicles, their S and their X vehicles. And it's interesting too that like they're making so many changes. Like they've just eliminated the 75 kilowatt hour battery pack option on the S and the X. So now you're kind of getting only the higher options for the S and the X, the more expensive vehicles. So they're kind of trying to streamline the production firstly of the S and the X, but they're also trying to differentiate it more from the Model 3, which is the baseline model.
Yeah, that's supposed to be the one that's sort of available to all consumers, right? The cheapest sort of, not cheap, but it is cheap in terms of price, but it's supposed to be a great value instead of the other ones that are sort of a bit higher up. Exactly. Did they end up coming out with that $35,000 Model 3 yet?
They're not in a position yet where they can make it. I think they're actually really crammed for space, it sounds like, in their factory. Their Fremont factory. So I think that's coming relatively soon. I don't have a time frame for it. I believe they said in the middle of this year. But yeah, it's crazy. They've really just been focusing, especially because the finances for Tesla have been tight, like just scraping through over the last couple of quarters. They're pretty much just focusing on selling and producing the most expensive versions of all of their cars while they've got the demand there for it. So they know they can make more money if they just start out with that and then kind of work their way down to the cheapest option. But yeah, they're not quite in a position yet where they can make the cheap model. They're not even making the most expensive models in right-hand drive yet. It's just all left-hand drive for America. So so there's still a lot of work to do, but I find it interesting. I think the earnings call for Tesla is happening next week, so it's going to be an interesting one to listen into, because I think that Elon Musk is one of the best CEOs, I guess, or managers of a company. So I'm quite interested to hear what he has to say, because there'll definitely be very sound reasons behind why he's doing all of these different things. So I'm interested to hear the strategy that he's going to talk about in the next earnings call, why they're doing what they're doing.
Yeah, absolutely. And speaking of earnings, we've got earnings season upon us.
Yeah, here we go.
We've got a ton of companies that are going to be reporting. Just to name a few, there's definitely more than this. Yeah. We've got Starbucks. If you don't know what earnings season is, basically every quarter, most of the companies report their earnings around the same time, and it's coming up now. So most companies are reporting their fourth quarter for 2018 or their first quarter for 2019. So the first one I had here was Starbucks is on the 24th of January. So we're recording this on the 24th in Australia. But that's going to be coming out on the 24th in America. Yep. So by the time you're listening to this, that will be out. Yep. So you can go check that out if you're interested. We've got Apple coming out on the 29th.
Yeah.
Also on the 29th, we've got eBay. On the 30th, we've got Facebook. Google on the 4th of February. Take-Two Interactive on the 6th of February. And the last one we've got here is Disney on the 5th of February.
Yeah, I chucked in Take-Two into that list just if you wanted to follow up from our podcast. I remember how we were talking about Take-Two is the company that makes GTA and Red Dead Redemption 2, Red Dead Redemption 1 as well, but so if you're interested in looking at kind of the sales numbers and that sort of stuff after those games and kind of how they're performing now after Red Dead's been out for a couple of months, you can go check that out. But yeah, the other big ones in there as well. What are you most looking forward to out of that bunch?
I think Facebook and Google. Facebook because I'm a shareholder of Facebook, obviously.
Oh, yeah.
I'd like to see Apple as well, just because of there's been a little bit of sort of stuff coming up about Apple, and they lowered their guidance, and it's always interesting to see what the biggest companies are doing.
Yep.
So probably Apple, Facebook, and Google. Yeah. Probably my main focus is there. How about yourself?
Yeah, I'd be the same. I really want to see what happens with Facebook. I'm really, because they've bounced back up. They're at like in the 120 region, so they're getting close to my margin of safety price. But of course, in classic fashion, they just bounce straight back up. So that was pretty annoying. So I want to see what's going on with their investing in their security and how much that's taken a toll on their profitability. Because Mark Zuckerberg said that it was going to take a substantial toll on their profitability. So if that could cause the share price to go down in the short term, I'd be very interested to see what the shares could potentially get down to. But we'll have to see if that even happens. And I'm also interested in Apple, just because of what you were saying with all that stuff coming out recently, and even with Tim Cook having to write a message out to all the shareholders saying that, you know, they're really downgrading their guidance and why they're doing that. It'll be interesting to see what the numbers actually come in at versus what he released to people, what he updated people as. So that'll be interesting.
Yeah, absolutely. And I'm just going to plug myself here. I'm going to be doing a lot of videos covering a lot of those reports on my YouTube channel. So if you're interested in any of that and you just want a concise version of some of those, you can go check those out. And I think we'll probably cover a lot of the big ones on the podcast as they come out.
Yeah, I have a feeling we'll cover them on the podcast. I have a feeling both of us will probably, because there's probably going to be some very interesting news coming out of some companies at earnings time. So probably keep an eye on both of our channels, because obviously we don't know what's happening yet because the earnings aren't released, but if there are some pretty decent stories or some pretty decent things to highlight out of earnings season, then you'll probably see videos coming out on both of our channels, I would imagine, about something. But yeah, keep an eye out. Keep an eye out for that for sure. And then what have we got? Last news story for the day.
The last story, just a bit of a fun one. So Amazon debuted their new delivery robot. Have you seen this thing?
Oh, right. No.
Have you seen this little... you've got to go check this out.
Oh, okay.
So just everyone who's listening to this, go and Google Amazon's new delivery robot. So it's basically like this little cooler sort of esky looking device on wheels.
Oh my gosh, look at that.
Drops off packet. It looks so like futuristic. It's... I watched a video on it before and I was just like, what is this thing? It's just, it's very strange.
That is amazing. Look at that little thing. That's hilarious. It looks like something that, you know, if you scaled that up, it looks like something that you'd find on like a Mars or like some Mars moon rover or something.
Like a rover or something, yeah.
That looks amazing. Look at it. Oh, it's actually pretty cute. Look at it go.
My first thought was, wow, that's cool. And my second thought was, wouldn't someone just pick it up and put it in their car and steal it? I don't know how they're going to deal with that. Yeah, like, does it have like a little gun that comes out, like a little minigun just like, defends it?
Please don't take me.
Just gives them a zap if they touch it.
Yeah, that'd be interesting. It's got an electric charge running through the outer shell until it gets to its destination.
Yeah, I don't know. It'd be interesting to see what happens with it.
Yeah, I reckon.
That's the same thing as their how they allowed the Amazon delivery people to go into people's houses, and they had that little camera that you can set up. Even that for me was just a bit weird.
That's weird. That's real weird.
But this just takes it to a whole nother level.
Yeah.
Your package is just roaming around on a little esky.
Yeah. I feel like you're gonna see a fair few of these little things hacked open. And left on the side of the road with no contents left inside. Because I imagine there'll be some sort of locking mechanism keeping it shut until it gets to the destination. I feel like Amazon might have a bit of an issue finding these broken into and left at the side of the road.
Yeah, I mean, just another interesting thing to keep us entertained.
Yay, entertainment.
This podcast is fun, guys.
Yay! Hey, I enjoy doing it.
Yeah, I do too. It's fun for us, at least.
Oh, well, yeah. We hope it's fun for you guys. But, you know, if not, no need to watch it. I mean, we're happy just sitting here chatting to each other.
Yeah, exactly. Doesn't even matter. Yeah. No, but that wraps up our news and our indices. So we'll get into the main part of this, which I'm really excited to talk about.
Yeah.
So Texas Roadhouse.
Yeah.
And, what's it all about?
Yeah, I'm super excited. Like I was saying earlier in the podcast, it was very interesting when you hit me up on Facebook and told me to look at this stock, and then it's got some good numbers behind it. So I'm really interested to have a look at it. Did you want to go through like what it actually is?
Yeah, sure. And just before we do, I just thought we'd start saying this because we probably should just to protect ourselves a little bit. But none of this is financial advice. It's just our personal opinions. So don't take anything of this as financial advice. And if you do want financial advice, then please seek out a professional. But in terms of what it is, so it's an American restaurant chain, and it's an American restaurant chain in the fast casual component of the restaurant industry. So if you don't know much about the restaurant industry, it's an $800 billion industry, so a massive industry. It's about 4% of the total US GDP.
That's
huge.
That's big.
It's a big component, which makes sense. Everyone's got to eat, right?
Yeah.
Everyone's got to eat.
Yeah,
that's
true.
The podcast for today.
Yeah, everyone's got to eat, and that's why this is a good stock. All right, see you later, guys. No, but it's so true. It's just like it's everything. Like it's recession proof. It's just because people got to eat. It's just like why, things like Coles and Woolworths. It's just like people, no matter what time of day it is, no matter what economic conditions we got, it's just like people still got to go and get their groceries. Same thing with like fast food. People still gonna eat. Maybe they might eat less because they're trying to save money or something. But at the end of the day, people still got to eat.
Yeah, 100%. And so I mentioned that it's in the fast casual component of the restaurant industry. So there's three main components. There's full service, which is your traditional restaurant that you would know, and that makes up 48% of that restaurant industry.
Yep.
Then you have fast food, which is the second biggest, and that makes up 43.8% of the entire restaurant industry. And then you have fast casual, which is a very small proportion of the restaurant industry. That is only 7.7%. And I guess you might think, well, if it's such a small component, then do they have room to grow? And the fact is that the fast casual sector is the fastest growing section of the restaurant industry. So just to put it in perspective, the fast food proportion of the industry has grown 160% since 2002.
Yep.
In comparison, fast casual has grown 500% since 1999.
Right.
So it's growing much faster, probably almost 3 times as fast as fast food, and it's gaining market share and becoming a bigger proportion of the restaurant industry faster than any other component of the restaurant industry.
Okay. So something to keep an eye on. Fast casual. I wonder what other places would fall into the category of fast casual.
Yeah, so I looked into this, and it's quite interesting because one of them is Chipotle. Chipotle Mexican Grill.
Yeah.
And if you listen to anything Phil Town says, he talks about this one quite a lot because
he loves it.
He loves it. He loves to bring this up as an example because it was actually one of his recent really successful investments.
Yeah.
The stock did really well coming out of the GFC.
Yeah. He loves Chipotle so much. It's pretty much like every time he uses the company as an example, it's Chipotle.
Yeah, absolutely. If you listen to his podcast, I think that's where he mostly talks about it. I'm not sure where else he's spoken about it.
Yeah, that's true.
If you don't listen to his podcast, go listen to it as well. After this, though.
Yeah,
after. It's more important.
After you watch every single one of ours. Yeah.
Yeah. No, a couple other restaurants that you might know that are in this sector are Wingstop, and Panera Bread is the biggest, I think.
Oh, really?
I hadn't heard of either of those. I'd heard of Wingstop and Chipotle.
Yeah.
But it's a very small sort of sector that hasn't developed. There's no really, really massive player in that sector yet. Like in fast food, what is it? It's McDonald's.
Yeah, exactly.
They're huge.
Yeah.
And that hasn't really happened in fast casual yet because it's just in the very infant stages of this sector. And I mean, to me, it kind of makes sense because we had the fast food sort of time where it's really popular, and now I think that people are going to be more health conscious, and they're not going to go from fast food to just sitting down at a restaurant full dining. There's got to be a middle ground, and that's what fast casual is. It's the middle ground between fast food and full service restaurants.
It's a really interesting concept, and I feel like it's already showing that it's growing so much. I feel like it'll be probably a decent performer in the future. It sounds like it anyway. It certainly seems to be gaining popularity. But I guess with that said, so that's kind of a good overview of what Texas Roadhouse actually is and where it sits kind of in its industry. Should we start? Let's start breaking it down into our 4M analysis. Starting, of course, with meaning. So did you want to talk about whether this company kind of has any meaning to you?
Yeah, so I've thought about this quite a bit, and I do find the fast food industry quite interesting. I've read quite a lot about McDonald's and the history behind McDonald's, and I find it really fascinating. There's a great sort of documentary/movie called Founder, that's about how it came to be.
Yep.
And if you're interested in the story of McDonald's, I suggest you go watch that, because it's a really great portrayal of how it developed over time. And I actually used to work at McDonald's.
Oh, right. There you go.
When I was a lot younger. And I find it so fascinating. It makes complete sense to me why McDonald's succeeded in the restaurant industry, or in the fast food industry.
Yeah.
And it's because they have such good systems in place to ensure, one, quality control and efficiency.
Yeah.
And you won't see it anywhere else.
Yeah.
In other restaurants, you've got, you just look into the kitchen out the back and it's just chaos.
Yeah.
But in a McDonald's kitchen, everything is positioned purposefully. There's the line where they make the burgers, there's the things on the side, everything, and everyone has their own jobs.
Yeah.
So there'll be one person operating the fries, there'll be one person making the burgers, there'll be one person taking orders. It's pretty impressive.
It's an efficient system. Yeah. I've always found that to be true when I go, like, even things like the drive-through. It takes you like 25 seconds to go from paying to going to that next window. And I'm always so surprised at the efficiency of their system that gets you your food like literally within a minute or 2 minutes. So they've obviously really nailed down like their systems, and their systems are obviously so efficient, and I think that's a big part of it. Yeah.
Yeah, so I mean, for me personally, I think it does have a little bit of meaning. I mean, it's not the most fascinating thing for me. It's not like I wake up and I think I'm just thinking about restaurants. Yeah. It's not like that. But I do find it quite interesting when I read into it, and it's not as if I'm reading the reports or I'm reading about how restaurants operate and I'm thinking this is just boring as.
Yeah.
I don't think that. I really find it quite interesting.
Yeah.
How about yourself? Does it have meaning to you?
I think that if I'm being perfectly honest, this is probably a bit of a stretch. I really didn't know anything about this company before you mentioned it to me. I think that overall it's something that I could like learn about more. And I'm like you, I do have an interest in that kind of industry, obviously because you see it everywhere. Like this industry is, especially like fast food, it's unavoidable. You see it happening all around you. So I do have an interest, and I have an interest as well. Like I've done a little bit of research around McDonald's, and it's interesting learning about their different strategies and how the business came to be and that sort of thing. But the way I look at Texas Roadhouse at the moment is that it's an American restaurant chain that already makes it hard for us to understand because we're so far detached from that market and that culture, especially. So overall, like I think like what we eat and the way we eat and all that kind of psychology and culture is really interesting, like what we were talking about. But I think there's no doubt that for me it would take quite significant researching to get on top of this business for me, just because it's so far detached from me just sitting here in my lounge room in Canberra. Like it's because there's no Texas Roadhouse chains in Australia, right? It's just it's just totally in America. Are they in anywhere else apart from America?
Yeah, you make an excellent point actually, because I would have loved to just go down and sit in a restaurant and see what it's like, but we don't have any in Australia. They are international now. They have, off the top of my head, they've got one in the Philippines.
Oh, right, okay.
They had one in Thailand. They had a couple in Dubai.
Yeah.
So they're just starting to go international.
Yeah. Right. Okay.
So they're starting to branch out. But they have, I think, 400 stores in the US or something. Yes, it's very, very American. And that is an excellent point. We might not appreciate what it's like in terms of like culture, in terms of, being an American.
Yeah.
Because it can be very, very different.
Yeah.
Even if we're both sort of Western countries, the culture between being an American and an Australian can be vastly different.
Yeah, and there's so many fast food or, fast casual, all these different brands that you see all across America, and a lot of them aren't even here in Australia. So although, we've got our fast food and we've got all of our different, restaurants and that sort of things that we can commonly see around Australia, the whole landscape, the whole, brand, like the brands that you see are some, like, obviously the main ones are the same, but there's so many more, like, I don't know, what's some examples? Things like, I don't know, In-N-Out Burger. That's one that gets talked about all the time in the US. I've never even seen, there's like none in Australia. I've never even seen one. So it's just like, yeah, even though like we've got our fast food industry and that sort of thing, just the culture around it and the brands that you see and the market shares and all that's so much different being in the States. It's just, we're not in that culture. So it makes it harder for us to get a grip on. So with that said, do you want to talk about like the actual business itself? Do you feel like the business of Texas Roadhouse is one that you could understand?
Yeah, so I thought I'd just sort of explain how you would analyze a restaurant business if you were approaching this and you wanted to learn more about it. So like any other corporation, there's a ton of moving parts, and there's always too many moving parts that you couldn't possibly learn about all of them. But I think comparatively speaking, it's probably on the easier side of businesses to understand, especially when you've got pharmacy businesses out there.
You hate pharmacy businesses.
It's just the first thing that pops in my head every time.
To me, it's banks. Banks are
true.
just like, ugh.
Banks would be in there for me too.
Yeah. Anyway, sorry.
No, but in terms of Texas Roadhouse themselves, so they own and operate some restaurants, which is they mostly buy them, they build them, and they operate them themselves. But they also have a franchise model, so other people can build their own, and then Texas Roadhouse receives royalties from the franchisees because they're using the Texas Roadhouse brand to make money.
Yep. Right. Okay.
Yeah. And sales growth. So if we're looking at sales growth, you can sort of look at it through two lenses. So there's the expanding of the number of stores. So that's going to increase sales, obviously, because if you have more stores, they're each going to be bringing in more sales, more revenue. And the other thing you need to look at is not just that, you need to look at the sales growth from existing stores. And this is measured by what's called comparable store sales. And that basically means that if you picked out a specific store, is the sales of that store increasing, decreasing, or staying the same?
Yep.
And that would be dictated by the number of customers who come through the door, and also how much each of those customers are spending. Because you can't just if you just have a business that is growing sales because they're putting up more restaurants, that might look good on paper, but if each of those stores also has declining sales within them, then it's not going to be sustainable.
Yeah.
The restaurants need to be becoming more popular within each of them, and they need to also be expanding the number of stores. And those two things combined will give you massive sales growth if it's a successful industry, a successful business.
Yeah, I agree with you. I think that's the only thing that I would have brought up as well, is that you need to watch the sales numbers within their stores, because you're so right. You see it happen all the time. It's just like on paper, some retailer has opened 100 new stores this year, and that means that their sales growth is through the roof because obviously they're selling out of 100 new locations. But then you look at each individual store and the sales per store are down like 10%. You're like, oh shit. So that's the only thing I would have brought up is to watch out for those little things where the numbers perhaps don't tell you the full story. But yeah, in terms of like, is it easy to understand? Again, I go back to my thing. Like, obviously we'd need to learn the context of this business a bit more, being in America, being in that sort of space. But in terms of like a fast food or a fast casual, whatever you want to call it, store, then it's a pretty easy business model to understand. Like, like it's not a bank.
It's not a bank.
Yeah, it's not a bank.
Absolutely.
I mean, they sell food.
Yep.
Yeah.
And I think that sort of wraps up the first M, which was our meaning and do we understand it, and is it easy to understand? And that sort of leads us into the second one, which is, does it have a wide economic moat?
Okay. Before we even talk about this, I'm going to put out a guess. And I'm going to say, because I haven't looked at the numbers just yet, I reckon that it won't have a moat.
Okay.
That's my guess.
That would be my guess too. Just if you just picture a restaurant, you can think there's so many different restaurants. How could you possibly have one that stands out?
Yep.
And what kind of moat could you have? So what do we even mean by moat? Let's just start with that. So when I say wide economic moat, I mean that the business has some unique characteristic that gives it an advantage over other businesses.
Yeah.
Because ultimately, if you don't have any, if you're the exact same as another business, you can really only compete on price. And that ends in one way. Neither of you making any profit.
Yep, exactly.
So in order to be successful over the long term and continue to bring in more customers and make more money, the business needs to have some protective moat around its castle that is going to allow it to protect itself from competition. And that is going to take its form in some unique characteristics or characteristic about the business.
Yeah.
So the first thing we like to do is that we just first like to look at the business and learn about the business and see if we can identify any kind of characteristic that would give it an advantage just from our understanding of the business. So I've done a little bit of research, but I've definitely, as we said earlier, we haven't finishing our conclusions on this.
Yep.
But essentially, a couple of things to point out in terms of can we identify anything is, so their mission statement of the restaurant is legendary food and legendary service, and management has done a lot of work in order to honor that mission, including not raising prices and not reducing portion sizes when margins get tight, when food costs go up, when labor costs go up. They don't really care too much about short-term profitability. They don't care if labor costs are going up. They don't care if the price of meat has gone up 10. Sometimes it was up 12% in a year, which is massive inflation on meat. And the CEO basically said, we're not going to sacrifice our food or our service just to make it look like we did better than last year.
Yeah.
That's not what we're doing here. What we want is we're going to focus on the customer, and we're going to continue to provide the best food and the best service. And on this topic, there is so many little things that I could talk about here. I actually wrote out a whole page of this, Brandon, before you saw this, and I deleted it.
Oh, right. Okay.
Because there was so many little things that you find when you read through the annual reports. It's actually ridiculous. I mean, just to name a few.
Yeah, hit me with a couple.
Like, if you go to their Instagram, I read through all of the Instagram comments on their photos. There is not a single negative comment on any of their Instagram photos or anything. Wow. I read reviews. Apparently their bread that they bring out, so they bake their bread fresh, and they've always got really hot fresh bread ready for you as soon as you come into the restaurant. Like the minute you come in, you see the bread house cooking the bread right there, and they give it to you. And people have said that this is just the best bread they've ever had. Same with the steaks. Each restaurant has a butcher in-house.
Wow. Okay.
And you can get your steak cut in any way you want.
Cool.
And apparently it's just the best quality that you can get anywhere. Even the employee reviews was saying that it was one of the best places they've ever worked. Most of them said it was the best place they'd ever worked. Right. And they got put in the top 50 best workplaces to work at.
Cool.
In America. One year. That's just to name a few. I could go on for ages about this. So don't believe me. Go read the reports.
Yeah.
They don't believe me.
Believe me. Do your own research.
Yeah. No, but go have a read and you'll be impressed by how effective management has been at trying to maintain that mission statement. And for me, that's a characteristic.
Yeah.
That's an intrinsic characteristic that other companies might not necessarily do. I know a lot of companies that have sacrificed quality and service in exchange for profitability over time. I mean, many companies have done this.
Yeah.
And I think it's for better or for worse. I mean, probably for worse. I think it's very important to just have a very customer-centric business.
And that's so important too. Back to what you're talking about as well. If you are focused on the long term and you don't change things in the short term because of, like what you said, meat inflated by 12%, the price of meat went up by 12%, but they didn't change their prices. They didn't, change their menus or their portion size or whatever. I'll say it the other way around. If you do have a long-term focused mindset and you don't break under the short-term little things, then it builds incredible consistency, and it means that the people that go there really understand that this is always what they're going to get. Like it's incredibly consistent, and there's a certain power to that, like knowing exactly what you're going to get. Like, you know, okay, if I go to, say, Texas Roadhouse, I know it's going to be, I don't know what their prices are, but, you know, I'm always going to get a steak for, I don't know, like $20, regardless of what's happening. It's always going to be that same portion size. It's always going to be that same quality, because nothing changes on the short term. They don't, you know, get rid of their butcher because they're trying to cut costs. They don't cut the size down because they're trying to cut costs. You know, they're always, if it's just the same, then that actually, people say that gets boring, but at the same time, it helps people understand exactly what they're going to get. It's just like, for instance, Subway. I always go to Subway because I know I can get exactly what I want, and that hasn't changed for like 10 years.
Yeah.
I know exactly what I'm going to get. I know exactly what I can get, and that just has never changed. And it builds that trust, and it makes your customers really understand that that's like a trusted place. You know you're going to get what you're going to get, kind of thing.
Yeah, absolutely. And just to sort of balance this so that it's not completely biased, me just saying, yeah, it's awesome.
It's great.
With that being said, I do think that this type of moat would be classified as a narrow economic moat, not a wide one. And I'll explain what I mean by that. Essentially, they do have a competitive advantage. I personally think that they have a competitive advantage over other restaurants because of their consistency and their high quality food and service, but it is a moat that can be crossed.
Sure. Yep.
I'll give you an example of a wide moat, and we talk about this a few times. We even did a podcast on economic moats if you want to see that one.
Yep.
But one of the wide moats that is probably one of the most powerful is a switching moat.
Yep.
And this is essentially where it's expensive or irritating to switch away to another competitor's product. So the example that we use is Adobe.
Yep.
So if you have a company and all of the company's graphic design or video production is done on Adobe products, on their software, on Premiere and on Photoshop, their employees are going to be trained to use that software. And if they were going to switch all their software to Apple's software, they would have to pay a lot of money to retrain all their employees.
Exactly.
So that's not it definitely is irritating, but it's expensive.
Yeah.
It's very expensive. So they've got those customers locked in. Texas Roadhouse doesn't have anyone locked in. Like at any time, another restaurant might pop up next door and be 100 times better just for some reason. For some reason, people like it better, and they can take market share from them. So they're not protected in a way where if you're looking at two restaurants, Texas and another restaurant, you don't feel irritated or anything like that to go to the other restaurant.
Exactly.
You could just go.
Yeah. And that's the other point. They can do all of this stuff to make sure that, you know, their customers know what they're going to get, and it's all great service and great food. But then again, like what was it? Legendary food, legendary service. But there's nothing stopping another place to also offer legendary food and legendary service.
Correct.
Yeah. So it's very hard in the restaurant space for strong moats to be established, because there's just like so many options. And it also depends, like what you get for dinner that night depends on what you feel like. So, you know, do you feel like going to Texas Roadhouse, or do you just feel like getting some Chinese food? Like, so I mean, like, yeah, when it comes to like buying a phone or a smart, like a computer or something, you know, you've got like a smattering of companies that you could potentially buy from, but really there's only maybe like 4 main players, say. But when it comes to something to eat, you literally have like thousands of options. So especially when they're all offering, at the end of the day, they all offer the same product, which is something to eat. So when it comes down to it, you've got a lot of different options to fulfill what you want. So even though you might have a very high quality business in this space, it is hard to cement a wide moat, because at the end of the day, there's just so many options, and other companies, other chains, other whatever, can also provide really good food.
Yeah, absolutely. And I guess just to summarize my opinion so far on this economic moat from what we can identify, I like what I see, but I'm not convinced. So if that was all that was great about this company, that would not be enough for me to make an investment because, as I said, it's a narrow moat that can be crossed. So the next thing we want to do is we want to see if that their numbers show us that they have a moat. Because if a company is consistently making more and more money, it means that they're doing something right. People, the customers love what they're providing, and consistently loving what they're providing, and loving it more over time. So we like to look at the numbers. The 4 numbers we look at are sales, earnings per share, equity, and free cash flow. And that gives us a nice broad picture of how this company has performed. It's a bit of a summary of all of the financial statements. If you didn't want to go through and analyze all of them. So I'll just run through some of these numbers. They're amazing. They're very good. Just to sort of start off with that, sales, they're amazing. Take my word for it. See you guys. No.
All right.
Sales over 10 years has been 11% per year. And every year that's been getting better and better and better. It's 11.6% in the last year. So it's really hovered around that 11 to 12% range.
Yeah, and 11 to 12% growth. Yeah.
Growth. Yeah. Every single year compounded.
Yeah.
So that's really impressive.
It is.
In terms of earnings per share, so that was the top line we just spoke about. Now let's talk about the bottom line, profit per share. Over 9 years, over the 10-year period, it's been 15% per year, which is outstanding. Now this one has been declining actually, but not by too much. So it went from 15 to 13 to 13 to 14.5 to 13.
Yeah.
So again, it's pretty consistent and it's
very
really strong.
Consistent. Yeah.
It is. Yeah. I wouldn't say that that's a concern of how it's declining. I mean, that's just the nature of an expanding business.
Yep.
If they bring out 30 new restaurants every year, that 30, 10 years later isn't going to make as big of an impact as it did when they had 5 restaurants.
Yeah, exactly.
So that's just the nature of it. But it is declining slowly, which is good. That's definitely a good sign.
Yeah.
And it's above 10% as we like to see.
Yeah. Yep. And it's just not choppy. It's just not choppy at all. It's consistent.
Too many companies it's just all over the place.
Here, there, and everywhere.
Profitable one year, negative the next year.
Yeah. Just like the 10-year number will be 10%, the 1-year number will be 15%, and the 5-year number will be like negative 3%. You're like, what?
So next year they're going to make...
I think... Yeah, anyway.
So the third number we look at is equity. So this is basically the book value, the value of the assets minus the liabilities of a company. And this over time, the growth of this over time is a pretty good indication of how the stock price will move. So over the 10-year period, it's been 10%. 7-year period was 8%. Then we've got 10%, 11.5%, and 12.3%. So that is growing over time, and it meets our minimum requirement of 10% over the long term.
Yeah.
For me, this is one that I focus on a lot. I really like to look at this number because, as I said, it's very telling of how a company's stock price will move over time.
Yeah, equity growth rate, is a big predictor in... I believe equity growth rate is a better predictor of future share price performance than earnings per share.
Yeah.
Is that right?
Yeah.
I'm pretty sure that's correct.
Yeah, that's the one that's what Phil Town says.
Yeah.
It's what Warren Buffett says.
Yep.
And it kind of just makes sense because at the end of the day, if the business wasn't producing anything anymore and you just had to sell the assets and pay off your liabilities, the equity number is what you would get as a shareholder.
Yeah.
So if that increases by 12%, if they have 12% more cash, then it kind of makes sense that the stock price should go up 12%. You'd be willing to pay 12% more because you're getting 12% more cash with the business when you invest in it.
Yeah.
And then the last one we've got is free cash flow. Now, over the 9-year period, we don't have a growth rate because I think it was in 2008 during the GFC, they had negative earnings per share.
Oh, okay.
Negative free cash flow. They didn't have negative earnings. They had negative cash flow. And the reason for that is it kind of makes sense. They were actually buying back their own stock when it was dirt cheap. So it's not a bad thing at all. Yeah, they authorized the buyback before the GFC, and then they started buying right at the bottom.
Genius.
Yeah.
Smart management.
They're good. They've made 10x on that, on their investments back in 2008 since till now.
Yeah,
So they did very well.
That's smart. Anyway, sorry.
Yeah, sorry, just rambling on. Chucking in more little nuggets. So for the 7-year average, instead, they've had 7.5%, which is a little bit low. We like to see 10% or more. But if we look at the 5, 3, and the 1, they're well above 10%. 5-year was 15%, 3-year was 23%, and the 1-year is 36% growth in free cash flow.
That's pretty good.
Yeah.
And does this factor into what you were talking to me about the other day about the management trying to really boost up their cash for potential future scenarios?
Yeah, so what I noticed, because I read through all of the reports, and they follow a very similar pattern. Well, they're following a very similar pattern now than when they did just before the global financial crisis, which was they started to pile up the cash. They stopped. They didn't stop making investments, but because towards the end of the cycle, they're just making a whole lot more money. Instead of buying back stock, like a lot of companies are, buying back expensive stock, they just pile the cash up like a good investor should.
Yeah.
And they authorized a buyback program, which means they're ready to buy shares, but they're not right now.
Yeah.
So they clearly think that the cycle's about to turn like it did in 2008. And they're getting ready to buy a lot of stock when it's cheap, which is a really good thing.
Yeah. So we should continue. We should keep talking about the management. So that's kind of like the growth numbers and the moat. So obviously, what do you reckon? Numbers do show that there's a moat, but it would be a narrow moat, not a wide moat like something like a switching moat. Is that our summary for moat?
Yeah, I think their performance over the past 10 years has been amazing.
It has been good.
The moat it's not necessarily wide enough to protect it. So what I'm then looking for is management that's in position now going to be in position for the next 10 years, and have they been really effective? Because that's going to be a good indication of whether or not we're going to see the stock price or the performance of the business, I should say, continue to go up, to continue to become better.
Yep.
And so that leads us right into talking about management. And I just briefly spoke about the skill component, like how good are they within the business.
Yep.
But we also need to talk about integrity. Are their interests aligned with ours?
Yeah.
And there's a lot of positive signs in this segment that makes me think that they do have quite a bit of integrity and that they're very transparent and they care about the shareholders.
Yeah.
The first one is that the founder is the CEO. So
that's exactly what I want. Yeah.
There's a guy, I can't even remember what his name is now. Kent Taylor, I think it was.
Yeah.
Back in 1995, that's a guess, but it's around that time. He had a dream of starting up his own restaurants. So he started up 10 restaurants by himself. And his first few did really poorly. There was poor quality control. It was quite interesting because it was quite a similar story to how McDonald's started.
Okay.
There was poor quality control. The service wasn't good. And he fixed all those things and he worked out how it could work. And he's built it now to where they have over 500 restaurants. And he owns 8% of the company. So his interests are aligned with the company.
Yeah,
it's his baby. It's his business. He wants to see it grow massively. And he's been there the entire time this company has been around, for about 21 years or something like that.
Yeah.
And he owns almost 10% of it.
Yeah. That's what you want. You want it's really good if you can find a founder CEO, because it's their reputation, it's their baby, it's their business. So as opposed to some other CEOs where they might just, I'm just in it for the money, I just get paid and I don't really care. Having a founder, it's literally like their name is on the line with this business. So
yeah, 100%. And just to support that, there is many other senior management that have been at the company from early on, if not from pretty much the start. And a lot of these people hold a lot of stock. So a lot of these guys, they might not have been the founder, but they joined the company when it was 3, 4, 5 years old, and they bought a lot of stock in the company. So it's not just the CEO that's got massive alignment of interests in there. There's other senior management as well. We're talking about the CFO, the COO, all these big players. They have a lot of stock, and actually, they have a policy where if you're in senior management, if you're an executive, you have to hold, I think it's at least $1 million in stock.
Wow.
So they make it so that you have to have your interests aligned with the company.
Yeah, that's actually pretty smart, I reckon.
The next thing that I liked to see was that they break out their numbers in a lot of detail. And that indicates to me that they care about transparency. That's what we spoke about that a bit earlier. Yeah. Transparency is really important so that we always know what's good, what's great that's happening in the company, and what's not so great.
Yeah.
So that we can work out if that's a big problem.
You want the complete picture, essentially. You don't want them to be, withholding information. The best CEOs are the people that just are completely transparent with what's going on in their company.
Yeah, 100%. So just to caveat that, the negative thing that I saw was that they do have a stock options program. And this allows management to be compensated by a short-term increase in the stock price. So if the stock price goes up within a year, they will earn more that year. And this is one of the things that Buffett and Phil Town say that you should avoid, because it basically incentivizes the management to have a short-term perspective, because they're going to make more money that year if they make the stock price go up.
Right.
And I mean, that being said, so that's a negative for sure. That being said, they are slowly pulling it back, and they've made mention of the fact that they understand it doesn't really make sense to have it, so they're slowly reducing it.
Yeah.
And the sort of just to balance that, a lot of these managers have stock in the company. So, and as we spoke about earlier, how they mentioned that they're not increasing prices, they're not ruining quality. Their actual actions are showing us that they are acting in a long-term perspective, even though they might have a program that could incentivize, cutting costs and doing all these things just to make a quick profit so that the stock price goes up. Their actual actions are showing us that they do have a long-term perspective.
Yeah, and that's the main thing. You want your management team to be long-term focused. So it makes sense. Like this isn't something that's very long-term focused at all. So it makes sense that they're saying, it doesn't make sense for us to have this. We're pulling it back.
Yeah, 100%. Another couple of things. The restaurant managers, what they make is a pretty moderate salary, but then about half of their salary, half of how much money they make each year, half comes from salary and half comes from the restaurant's profit. So the restaurant that they actually operate, the individual restaurant, they get a decent amount of the profits that restaurant generates.
Yeah, right. Okay.
And that's another big incentive for them to continue to produce really quality and quality service and quality food, because half of their salary is going to come from the profits.
Yeah. So that's a great incentive. It'd make me work harder.
Yeah, and I mean, there's just a lot of little things that they're doing. I mean, they've been smart with their buybacks. I just spoke about that before. They waited until it was really low. And I mean, I could go on and on and on.
Yeah.
You definitely read through the annual reports and you'll get a feeling for the kind of culture that the CEO, who is the founder, and the senior management, what kind of culture they're trying to create. And it is very owner and customer oriented.
Yeah, that's what you want. So that shows that they've got good integrity, all that sort of stuff. Like they're in it for the right reasons. And then if we flip it over and we start having a look, okay, sure that they're in it, they're doing it for the right reasons, whatever, but are they actually any good? Are they good at doing what they do for the company? So if you have a look at our first number, which we always look at, the return on invested capital, and we have a look over firstly 5 years and then over 1 year. So for our 5-year average, you're getting a return on invested capital of 14.6%, which is very good. That's good. Yeah, it's quite impressive. And then in the last year, they've even been more effective than the average at 17.51%. So the management team's ability to take the capital at their disposal and invest it back into their own business to generate even more profit is very, very good. They're very good at doing that. And then the other thing to have a look at, sure, they can invest it well, but can they also protect their company from the impending doom of debt? So now we get to some of the debt ratios that we look at to see, how good is management at making sure their debts don't get too out of control. And we look at the current ratio. So the current ratio, what number do you normally look at? Over 2?
Yeah, so I'm usually looking for over 2.
Yeah.
And for this company, they have a current ratio of 0.8.
Right.
It's on the low side.
It is.
It doesn't meet my standard.
Yeah.
Although it is getting better over time. So
Okay.
it's been worse in the past, and they're slowly building up that cash position, which is making this look better.
Yeah. And then for the debt to equity ratio on the flip side, so this is comparing, how much the company is running off debt and how much it's running off equity. We're at a ratio of 0.56.
Yeah, and that's excellent, because that means that they have twice as much equity in the company as debt. I personally look for below 0.5, so it's right about that cutoff.
Yeah.
And for the most part, I'm just looking to see that they don't have more debt than equity, which would be a debt to equity ratio of above 1.
Yeah.
And I also like to look to see if they have enough cash on them to pay off debt. And they always have enough cash to pay off debt.
Yeah, that's what you want. Yeah, pretty much you got to make sure it's much more equity than debt. So yeah, if that top number in that ratio is low, and then the bottom number is very high, then you're going to get a very low number overall, and that's exactly what you want to look at.
So that kind of wraps up looking at the business. So do we understand it? Does it have some kind of intrinsic characteristic that gives it an advantage? And what is management like? And that's sort of one proportion. And then we also need to look at how much we're paying for it, because it can be a great business, but you need to pay the right price for how much cash you're going to get back from this business. So I did 3 intrinsic value calculations here just to sort of see what each of them show us. The first one was margin of safety. That's the one taught by Phil Town, if you're interested. I used a growth projection of 10%, so that's based off their past equity growth.
Yep, that's fair.
I used a PE ratio of 20, which is 2 times that growth rate.
Yep, fair.
And that gave me an intrinsic value of $28 per share, which means that we would be willing to buy it at 14.
Yeah.
Which is a long way away from where the stock price is right now. It's at about 65.
Hamish, it almost seems like this is a bit of a trend.
Yeah, every time it happens.
To be honest, it's like it's so depressing. I want to be able to talk about stocks that are right there, that are in that zone. Oh, it's just so depressing at how overvalued everything is.
Yeah.
And I think it gets to a lot of people, and they end up making silly decisions and buy stocks when they're way too expensive. But well, we shall wait. But anyway, that's just one of our valuation methods, right? So we've got another couple.
Yeah, so the second one I did was payback time, and this one's also taught by Phil Town, but it's more widely used in the industry. So I've used cash flow growth of 10% into the future for the next 10 years, and that gives us a payback time of 11 years. So that means that it wouldn't be a buy because it's greater than 8 years.
Yeah.
And just to sort of give us a comparison, the payback time of 8 years would give us an intrinsic value of $40 per share, which would mean it would be a buy at 20.
And a buy because of our margin of safety.
Yes, because of the 50% margin of safety.
Yeah, exactly. Okay, so that's interesting. So that one is maybe telling us, so first one was 14, second one 20. So hopefully this one's 26, right?
No, not quite.
Not
so the
quite.
last one I did was just the traditional discounted cash flow. And this is the method that Buffett likely uses. I don't know for sure, but he talks about it. He talks about intrinsic value in a way that indicates to me that he uses discounted cash flow. And again, I used a growth rate of 10%, and I targeted a return of 26%. So that includes the 15% that we want to make and a 50% margin of safety.
Okay, yeah.
That's bundled all into that.
Cool.
And that gives us a buy price of $15.40.
Right, okay.
So they're all around that $15 to $20 buy range with an intrinsic value of around 30 to 40.
Yeah.
So we believe that it's above. It's currently priced well above its intrinsic value, and well above any price that we would be willing to pay.
Yeah, it's at $65 US right now.
Yeah, just to sort of give you a little bit of hope, in the last recession it went down 75%.
Right.
But that, I guess, it was the GFC, so that might be a unique event. But it's possible that it could go down 50 or 60% and get quite close.
Yeah.
But then again, there might be better opportunities if the market goes down 50 or 60%. So we just have to keep this in the back of our brain.
Tag it.
Keep learning about it. Keep learning about the restaurant industry, and see if when the market does downturn, if there's better opportunities.
Yeah.
And if we can't find any that we understand, then this could be a good one.
This could be a good one to watch out for. Yeah. So sits on the companies to keep an eye on for me.
Absolutely. Same with me.
All right. Well, that's Texas Roadhouse. Now we're going to keep this brief and just go through one Q&A question for today, because our stock breakdowns go on for a long time. We like to talk a lot with our stock breakdowns, but that's okay, because I just think that's what the podcast is for, just trying to give as much value as possible and trying to go into stocks in as much depth as we possibly can, getting two heads on it instead of one. So hopefully you guys enjoyed that. But yeah, our first Q&A question and our only Q&A question for today is, I would love to hear a discussion on weighting. I'm seriously considering MVW instead of VAS or similar. I guess they're ETFs. Comes with a steeper fee though. Love your channels, guys. Always listening on my way to work. Thanks for the support, brother.
Awesome. But for those who don't know what MVW is, it's just another type of index that weights the different components of the index in a different way than traditional index funds do. Yeah. So you get an equal proportion of each company rather than higher proportions of the bigger companies. Okay. And my response to this would be, I've personally just never really explored weighted indexes, because when it comes to index funds, I just want to track the market.
Yep.
That is a passive proportion of my portfolio. I'm not trying to get fancy. I'm not trying to beat the market or anything with a different kind of portfolio. I just want to track it.
Yep.
And the ASX 300 has returned almost 10% per year for the past 100 years.
Yep.
So that gives me confidence in buying a traditional index fund like VAS. And when it comes to different index funds, I just have no idea how they've performed in the past. And I therefore have no reason to believe that they'll do better than a traditional index fund. So I don't give it too much thought. With that being said, I guess it's not as if I'm 100% a passive investor. I have about 15% of my portfolio in an index fund. So then I don't give it too much thought. But if you are a 100% passive investor and you just want to get a little bit more involved, then you could learn about these things. But as I said, I have no reason to believe they'll do better than an index fund. Yeah. What do you think?
No, I think similarly. If I'm using an ETF, I'm being a passive investor. And the only way that I know how to be a passive investor is to trust in the market return. In fact, that's the best way. If you're being truly passive, that is what you want. You want to try and just get the market return, because as soon as you're starting to play around with different weightings, or even some of these ETFs that are like resource ETFs or healthcare ETFs, then all of a sudden you're not being a passive investor anymore. You're being an active investor. You're not being someone that is just trying to participate in the market. You're being someone who is now trying to beat the market, and that is not what passive investing is all about. And then when it comes to, so if I was going to be, okay, let's say I didn't do any passive investing and I was just an active investor, well, in that case, I'm much more interested in assessing individual businesses to try and sink my money into really strong companies at margin of safety prices. So for me, there's just, in my personal strategy, there's just not a place for any sort of index fund ETF that sways away from just the plain old, stupid, boring market return.
Yep.
Yeah.
And I think that is a good a time as ever to wrap up the podcast. Thanks everyone for listening. And if you do have any questions for the Q&A section for next week's podcast, make sure you leave them below the comment section of the YouTube video, which is going to be on my channel this week. So if you didn't know, we're alternating between the Aussie Wealth Creation YouTube channel, which is Brandon's channel, and my channel, which is Hamish Hodder. So go check that out and leave a comment if you have a question for next week, or if you have a topic for the middle section.
Yeah.
So again, I hope you guys enjoyed listening to this one. Thanks for joining me as always, Brandon.
Oh, no worries.
And we will see you next week.
Yeah, see you guys.